Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report. Corey and Chad here, your hosts for this weekend's edition. This weekend show, we're going to focus again, trying to make some sense of what's going on in these volatile markets. Big picture in terms of, are we back in a bull market? Should we still be bearish? These questions seem to be getting a lot of mixed answers from a lot of our guests. And then in the back half of the show, we're going to switch a little bit more over to the resource sector, especially in terms of the precious metals. Just as a note, please be sure to listen to all our daily editorials and company updates posted throughout the week on our website, podcast, and YouTube channel. Please subscribe, share, and comment within those platforms as well to help get the word out and grow our audience. We appreciate all the support that all of you, our listeners, give us. Without further ado, let's get into this weekend show. We're kicking off the show with Mike Larson, editor-in-chief at MoneyShow. Mike, it's been a little over a month since we last had you on. We should mention that we are recording this weekend show on Wednesday, right after the markets started to drop on the back of a bad bond auction. Markets broadly have been volatile, though, if you consider that the S&P went down 20% in a month and a half and then up 20% in a month and a half. Not back to all-time highs, but that's crazy volatility. During this recent rebound, does seem like we've had a lot more people, again, join the bullish side. There are gains to be had in a lot of different sectors, but it brings up that question, did we all get a little over our skis in this Sell America trade? A lot of this was self-inflicted, but at the same time, this pain can last for other countries, how they view the U.S. So, Mike, that question, the Sell America trade, is it behind us? Did we make too much of it?
Yeah, it has been a crazy environment, and thanks for having me back on to kind of get caught up with where things stand and sort of what I'm seeing out there. I think, the walk back that we've seen from the Trump administration on a lot of the tariffs, the worst of the tariffs. I mean, you remember that chart that they held up at the Rose Garden ceremony with all those numbers, and, we're tariffing small islands in the Pacific and Atlantic, and things like that. Those numbers just kind of spooked the markets considerably because they looked a lot larger, a lot higher than what people were expecting. A lot of that's been walked back, and now kind of the expectation is it's back to, throw a bunch of bluster at the market and then ultimately make, some kind of deal down the road that dials a lot of that back. That's that part of the crisis or whatever that provoked the big sell-off in April and then the big rebound on the walk back. That part of it's kind of over, but now the bigger issue that I shouldn't say over, but at least, it's gone from sort of a 5-alarm fire to a 2-alarm fire. The bigger issue for this market now, I think, is the broader deterioration in the U.S. fiscal position, growing budget deficits, growing debt loads, no sort of political will on either side of the aisle, Republican or Democrat, and Republican administration or Democratic administration to do anything about it except lip service. And that's what's starting to really spook the markets. I mean, it's interesting, as part of the tariff fall, one of the issues that came out of that for the U.S. bond market and U.S. interest rates was that if you're not recycling a bunch of trade surpluses, or you're not buying a bunch of foreign goods from countries like China and elsewhere in Asia, and they're not taking that money and buying your U.S. treasuries with it, if something breaks that kind of sort of symbiotic, they send us stuff, we send them money, they send it back to us by buying our bonds. If that process gets disrupted, there's less demand for bonds, therefore interest rates go up. So that was sort of the bond market implication of Trump's tariff plans and so on. But now on top of that, you have things like the negotiations right now in the U.S. House, and depending what comes out of that, eventually the Senate, this quote unquote big beautiful bill that the president would like to see passed. The issue is that, it has some Medicaid spending cuts in it, but when you factor in the impact of extending some tax cuts, potentially adding to them, and those spending cuts not being enough really to move the needle as much as people would like to see, I mean, independent analysts are saying this is a $3 billion almost budget buster in terms of additional deficits between now or over the next 10 years. So so you're throwing that into the market that they're trying to get this thing passed. That's riling up bond traders. And on top of that, you had the Moody's downgrade last Friday. Now, is Moody's a day late or potentially 10 years late and a buck short? Sure. I mean, the ratings agencies always are. But what's interesting is that it's sort of being thrown on top of everything else. I kind of describe it as lighter fluid on top of a fire that was already, underway or kind of smoldering and so on. So it's not that, Moody's downgrade equals sell a bunch of bonds and drive rates up. It's more that the market was already worried, global investors were already worried about US debt, US deficits. On top of that, you get this downgrade. And oh, by the way, we're going to try and add, do some bill that's going to add $3 trillion more to the deficit. So, it's not the downgrade specifically, it's that it just adds to all these other concerns that were already out there. And it comes amidst, again, this sort of sell America trade that's been going on for months. It's been US stocks underperforming, foreign stocks outperforming, US bonds going down in price, rates going up, and money rotating overseas, the US dollar going down, and things like gold and silver rallying. And even, just today, as we're speaking, or earlier this week, by the time this airs, Bitcoin tagging an all-time high. So, you have to look at these things, I think, in the big picture, sort of with a holistic view and say, what explains all these different markets doing all these similar or different things, and it's all part of that general theme that concern that the U.S. isn't getting its fiscal house in order. On top of that, volatility is going up because U.S. policymaking is much more slapdash. The side effect of the tariffs could be to mean less money is recycling back into U.S. assets, and it's all part of those big trends. So I think. I don't think this is the start of some huge new bear market. I don't think this is kind of like, a 2007 moment ahead of the great financial crisis or a, 1999, 2000 moment ahead of the NASDAQ crash. But I do think you have to be much more selective. I mean, I do think you've got to narrow your focus. You got to kind of pick and, whatever sort of metaphor you want to use, pick and choose your battles. You use sort of a rifle approach, not a shotgun. I could go on with those metaphors, but the point being, as an investor, this isn't something, I think fewer chips on the table, a little less aggressiveness, zero in on certain themes and sectors and subsectors that work, and just recognize that it's a riskier environment, it's a more volatile environment, and that kind of environment you don't go crazy.
Yeah, Mike, I think that's a great summary of the lay of the land. And it's interesting with the Moody's downgrade and with some of the recent press about the swelling deficit and the fiscal side of the U.S. I mean, that's been a problem for many administrations. It's been growing. We've been talking about the debt bubble growing and becoming unsustainable for over a decade, it seems like. But at this kind of an environment, a couple of years ago, your message was to be boring and to go with the safe havens. Then it shifted a couple of years ago to be bold. Now you're saying be more selectively bold and to pick your spots. So if you're using that rifle approach and if you're going in for certain areas, it seems like there's a rotation out of maybe some of the mega cap tech and into other sectors. What sectors are you being selectively bold in?
Yeah, absolutely. I mean, I think that selectivity or selective term is very important. I think I've been a bull on precious metals and equities related to that for some time. It doesn't take a rocket scientist to note that when you have gold blast up to 3,500, when you have silver look like it might be starting to break out, when you have platinum that, just had its best single day since in like what, 3 years or something, that's telling you that you're seeing this rotation into metals as an alternative to bonds, a safe haven in times of more political volatility and so on. And I don't think that, and as a dollar insurance play, and as a central bank reserve play. So all the, as bullish as I was about the sector before, I'm very bullish. I'm even more so now. And I think for the rest of this year and beyond, we did take some froth out of the market because we blew past 3,500 US in gold and then pulled back. We're sort of consolidating those gains, but I don't think that was kind of a blow off top for the end of the whole bull market. I think we're just going to ultimately need to consolidate for a while before a new leg up. So I like that. I think there's, some defense, not necessarily defensive, but defense type stocks. I mean, whether it's European countries spending more on defense, given the sort of drawback of or potential drawback in NATO and what's going on there with the Trump administration, longer term that you're going to see those countries spending more. You're going to see Taiwan and some of these other places that are afraid of China spend more. So, defense looks like an attractive place to be. I always kind of say you got to invest for the world you have, not the one you want. And I think, unfortunately, or what have you, this is going to be a more uncertain and dangerous geopolitical environment. So that's something to look at. There's subsectors of this kind of industrial market and even financials where you've got looser credit stand or looser oversight, bank oversight, regulatory oversight. I think that's why that sector's done pretty well. So there's some financials you can look at. Those are the kind of, and bargains in energy, traditional energy, and even renewables. I think, that's been a beaten down sector. There's concerns that OPEC oversupply and drill baby drill is going to, lead to some supply glut. But in reality, I think the sector is more disciplined than it was in the past. They kind of learned their lesson during the shale oil, boom and bust. So I don't think U.S. producers are going to be flooding the market with oil. So I think there's some bargains there. So those are a few things I'd be looking at for different reasons. But you can see, like again, it's not a buy everything because A, B, and C macro forces are going to drive almost everything up. It's more of, hey, I can find a story that I think makes sense in this subsector. And by the way, I can find another story that I think makes sense in another subsector. It's definitely more selective.
Let's talk a little bit about that gold trade then, compared to the markets. If you do see a selective environment, maybe not that crash scenario that some people were touting for US markets, do we still see that inverse correlation between gold, even the gold equities that have more followed gold compared to the broad averages?
Yeah, I think, look, it's not a surprise to me that precious metals have outperformed equities. I think that it's something I kind of predicted and expected and said so publicly and in our previous conversations. I don't really think that ends. I mean, there's so many different things I think precious metals do for you in this environment. They're insurance against a declining dollar that is, part of the sell America trade. Plus, frankly, the administration wants a lower currency. Look at what happened to the Taiwan dollar the other day. Look what happened in South Korea. It's clear that there's wink nod negotiations, or probably at least unstated desire from the Trump administration to have a weaker dollar and to rebalance the U.S.-Asia trade relationship by driving the dollar lower against currencies in that region. So that's a reason to put more money into gold, silver, precious metals generally, and related equities. The central bank reallocation of reserves. I mean, there's a lot of things, and just volatility insurance. There's a lot of things that kind of line up behind that part of the market that I don't think are short term or, couple of month type things. They're, several quarters to a few years kinds of things. And I think, as a result, it's not surprising to see precious metals do what they do. It also is my expectation that they continue to do that and that the bull market continues to run for some time. So that's probably one of the spaces in the market that looks extremely promising to me.
Mike, how are you looking at something like silver, which is part precious but also part industrial? Same thing with copper, where it's mostly industrial use, because the narrative has been, oh boy, we're getting ready for a giant contraction or recession or possibly a depression. And the sky was falling really just about 6 weeks ago. Now people are unsure of whether that's going to happen. Are you in the camp that we see that big contraction where it hurts commodities, or are we in a reflationary trade where it actually helps commodities?
No, I don't think we're in a deflation economic crash, get out of anything sensitive to the economy type market. I really don't. I think if anything, you're going to have parts of the world like China that are going to respond to U.S. pressure, U.S. trade rebalancing, whatever, by trying to stimulate, right? I mean, that's been sort of the Chinese economic playbook for some time. And they're not going to sit here and just, take the abuse from the Trump administration or what have you without doing anything. So I think if anything, you might see some kind of, reflationary spending there. You have other parts of the world that are going to be, opening up their checkbooks a little bit more. I mean, again, things like even Europe, defense spending, that's going to cost a lot. There's going to be demand for things that go into all the materials that they're going to be buying and spending on. So I think the move that we saw in platinum is noteworthy. I think silver is really kind of on the cusp of a breakout. I know it's been a little bit of a wait for Godot type situation there, but I think that it's got enough gas in the tank from the broader precious metals trend and even from some stimulative type spending trend that, yeah, I think silver follows. And I've said that for a while and it hasn't. So, I'm going to obviously state the obvious there. I've expected it to follow and break out. It hasn't yet, but it looks promising to me.
Mike, if we do see silver spike, and also this other theme that's running along my head is the junior stocks also catching a bid, especially in the precious metals space, that can happen end of cycle. Not saying that definitely marks the top, because it can go on for years if that bullish scenario keeps playing out, and you can see some massive gains in those smaller sectors like silver, like the junior stocks. How do we go about understanding when a top might be, or understanding just what stage of a bull market we're in, as we have seen really the playbook play out perfectly, where the metal move, the majors move, the mid tiers move, and now the juniors are starting to move?
Yeah, I mean, to me, I always kind of say it's like that old, what, the Supreme Court thing, like with pornography, I'll know it when I see it, or obscenity, I'll know it when I see it. I think that there are certain things that it's not necessarily a quantifiable hard and fast rule. I will sell junior miners when GDXJ goes up X percent for X number of days or something like that. It's more of, do I see, true euphoria, people talking about this stuff on television all the time, chunk gains day after day, week after week, and so on. Those kinds of things are the I don't know, the kind of stuff you saw sort of in the 2010, 2011 cycle where, silver, blasted to the moon, and junior miners were, just this euphoria, the euphoria trade was running through that. I wouldn't say that we're seeing that yet. I mean, I'd say there's optimism. I'd say there's more adoption, certainly, than we saw earlier in the cycle. I mean, we were talking before, like, hey, I remember it was kind of a common question. Okay, when are these stocks finally going to move? And that was sort of the thing we were all watching and worried about. Now we're seeing it. Again, in the short term, when gold sort of blasted through 3,500, reversed, dropped 100, that one day, I think it was something like a $200 price range from high to low. I mean, that's the kind of shorter term stuff that if I were trading the futures market, I would make me kind of cautious, pull back for a little bit to consolidate. But in terms of the equities, I don't wake up or turn on the TV and see a new mining company on the New York Stock Exchange raising money every day, or other exchanges. I don't see sort of a absolute euphoric action in a lot of these companies. So I mean, certainly the gains are nice, but I don't think what we're seeing is just willy-nilly buying up of every lousy company that makes up some story and doesn't have the the drilling results, acreage, or whatever to stand behind it. I don't think you're seeing that kind of behavior. So I think this is bull market behavior, but not euphoric. So I wouldn't give up on it yet, I guess is kind of how I'd summarize it.
Well, Mike, you brought up the energy space too, and I think it'd be nice to dive into that. It has pulled back. It's definitely not euphoric in oil and nat gas right now, but it could be a great time to be buying this dip, because it seems like some of the concerns about OPEC and the U.S. flooding the market with oil are maybe a little overstated. How are you looking at the traditional energy space?
Yeah, I mean, again, with the commodity not cooperating, are you really going to see great outsized gains in a sector like that? I mean, no, you're just not. So it's more, you're kind of so I don't think it's a sector that I would go overboard in targeting, but I do think that there are some bargains being created. I do think that it's it's a sector that is not going away. The whole traditional oil versus renewables, I don't think it's going to be something where this is all just gonna go to pot and so on. So I think it's again, it's something you want to have some exposure to. You want to sort of buy here and there some bargains, but I wouldn't like seriously overweight it, expecting oil is going to run to $100 and you're going to make 40% in a month or two in energy. I think it's more like, okay, find some nice yielding companies that have low cost of production. If I were a U.S. based investor, I'd probably be looking at some of the foreign producers, Canadian or elsewhere, where you might get a little currency kicker as well. Just sort of be patient. I mean, I think that it's something that just like I don't see oil vaulting to $100 anytime soon. I certainly don't see us going to 20, 30, or even $40. So I don't think that sector is going to get hammered and collapse or anything like we saw back in the COVID days.
What about those renewable sectors then? Look, this whole we need more energy. There is a mix of energy, and we see a lot of different energy sources continuing to grow. The renewables, though, those have been, in a way, kind of bashed down by the current administration, taking away some of the funding and, quite frankly, just talking negatively about it. You still sound fairly confident that they will be around and they're still here to grow. So where are the opportunities there?
Well, it's funny when you go back and look at how some of these alternative energy stocks performed historically, they actually, ironically enough, and I don't have the numbers in front of me, but I remember we did this as a study for one reason or another. You saw a lot of the solar and some of these other equities do very well or do better in the Trump administration than they did during the Biden administration. And part of that was there was just so much, supply and so on, other things being thrown at the renewables market during the Biden administration that people weren't making as much money and there was a lot of competition and so on. Whereas you kind of had the opposite in Trump 1.0. So I don't think that those kinds of stocks are going to be some kind of disaster just because we're in more of a drill baby drill type environment. If anything, I think there might be less just sort of bad ideas getting funded in the sector because so much money is being thrown at it that it pressures even the companies that have real business plans and real operations. So I think that you do have some potential there. I mean, again, though, we all know renewable pricing and renewable companies are going to trade in some way along with traditional energy prices because obviously when it's all tied somehow to the price of energy. So if oil's not moving or if oil's kind of then you're not going to see much performance in the renewable space either.
What are your thoughts on nuclear power, whether it's powering AI's future with small modular reactors and the nuclear stocks, or uranium just for the power requirements needed for not just the U.S. fleet, but the global fleet?
I'm not a big specialist in that sector, so without it kind of sounding like I'm trying to beg off, I will beg off a little bit and just say, I think that nuclear energy has to be part of the solution. Utility demand driven power demand growth driven by AI and spending is something that a lot of our experts at our events, both live and virtual for MoneyShow, have talked about. People who do specialize in the sector, whose work I do read and, I think has been right more often than not, and therefore I respect. They're pretty bullish on that space. So I think that as long as that's the case, again, me as a generalist, I think it's intriguing to me, but I couldn't drill down really to the nitty gritty other than to say the people that are specialists in that part of the market and that are sort of under the MoneyShow umbrella have been bullish, tend to remain bullish, and I don't have any reason to disagree with them.
Let's also switch focus and talk cryptocurrencies then, because Bitcoin has also been running. As we record this again on Wednesday, today it almost hit $110,000. It's been a very quick rebound, and we had somebody on earlier saying that Bitcoin can also be viewed as a safe haven, but we also hear that Bitcoin also trades in line with tech. How do the cryptocurrencies fare in this environment where you, as you said, need to be selective?
Yeah, I'm glad you brought that up because, I said it in my opening remarks at our recent Miami event last week, and it's been my view that I've brought up before. I like the theoretical story of Bitcoin being an alternative asset, a digital gold, whatever. I mean, on some level, that argument makes sense to me. But I've always also noted, hey, I follow how markets actually trade. And like you just said, Bitcoin has tended to trade like a, tech stock on steroids or the QQQs on steroids. It might, and I say might, be breaking that pattern. And one thing that I've said always is I'm open to the idea that this could be another alternative. I don't think it replaces gold. I think, and other safe havens, but I think it could be a complement to them if it can break that, QQQs on steroid type trading pattern. It does seem to be doing that in the shorter term. If that were, again, today's the day, NASDAQ's down 0.9% as we're talking. Bitcoin just, again, blew up or hit a new high before pulling back. Now it's down about 0.3%. If it can if that sort of, break of the link can happen and continue, then, I'm all for it joining in the party that gold and silver and some of these other metals are already sort of enjoying. But it's tentative at this point.
Fair enough. Look, I think there is still a lot of question marks out there around this market just because it was a fast crash and a just as fast rebound. And now we're all left, I think, scratching our heads saying, where is the next trend? What is the next trend? And quite frankly, when you have moves that big, it sets up such a big range that simply looking at higher highs, higher lows, lower highs might be difficult here because this is just a massive swing that we saw in a matter of 3 months, both down and up. I think it is important to pay attention to those commentators that aren't always on one side of the trade to really get a handle of maybe where the opportunities are, because it does seem like there are a lot of opportunities, but again, what is that next trend is the biggest question. Again, this has been Mike Larson, editor-in-chief at MoneyShow. Mike, it's always great having you on the show, and everyone, stick around. We're going to be right back with Axel Merk.
Thanks, Corey. Take care.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back to the weekend edition of the KE Report. We are now chatting with Axel Merk, President and Chief Investment Officer at Merk Investments. Axel also manages the ASA Fund, active participant in resource stocks, especially precious metal stocks. Axel, let's start off by discussing the volatility in markets. It reigns supreme. It was actually a lot of people's thought that it would happen this year. A lot of volatility in markets because of the new administration really shaking things up with trade, and also the fact that the markets were on almost a historic run over the last couple of years, that being the U.S. equity markets. Well, the last 3 months have been a wild ride. Down 20%, up 20%. Everyone, I think, scratching their head saying, was that just a short-term shakeout with a long-term bull market ahead of us? Or truly has some damage been done to the markets and the global perception of the U.S.? Axel, what side of the coin do you stand on when it comes to that debate?
Corey, great to talk to you again. It feels like ages. Probably hasn't been that long ago that we last talked. I think you're setting up the question very, very nicely. We've clearly had what I would call a volatility shock. Like Liberation Day was a shock to the world. And that quote-unquote shock is somewhat over in the short term anyway, because guess what? We need to get tax reform done, and maybe we shouldn't cause all this turmoil in the markets at the same time. And the real question is, as you point out, right? Was this it? Like, is this normal volatility and we move on? I published an analysis before Liberation Day suggesting that tariffs changed the plumbing of the global financial system. And so I'm in the camp that this is much, much more than a volatility shock. But of course, whatever happens in the short term, including this volatility shock, of course, can overwhelm that in the short term. When you put a wrench into global trade, you're not just affecting the flow of goods, you're also affecting the flow of money. And the reference I like to give is there's a camp that talked about the Trader Joe's example. You have a trade deficit with Trader Joe's. Well, what people don't talk about in this example is that if you were to have a quote-unquote trade balance with Trader Joe's, your local supermarket, not only would you get fewer goods, but importantly, Trader Joe's would get less money. And so if you apply that to the US, when you inhibit trade, what will happen is there will be less foreign money helping to finance US deficits. And that is a key reason why long-term rates have been moving higher. And obviously there are some side effects from that, right? There's going to be pressure to keep rates low, either through fiscal discipline, and let's just leave that aside for a moment of how fiscally disciplined our politicians are. But the other one is, of course, the pressure on the Federal Reserve might increase to keep rates lower. And I believe, and the thing that's really fundamental about this is that the entire economic engine, what is referred to as the exorbitant privilege, is based on this sucking of international money into the US. And the US can be thought of like a giant bank or a giant hedge fund where people borrow cheaply in the US in search of higher returns abroad. And that's also why when foreigners borrow money and for invest abroad, when there's a volatility shock, people repatriate the dollars because they de-lever, and that's a short squeeze on the dollar. We haven't seen that, which means this movement to change the plumbing is firmly underway. But it means that the ability for the U.S. to have a blank checkbook is at risk here. Now, by all means, the administration is not completely dogmatic about tariffs and all that, but I do think that 10% baseline is the new normal with some punitive tariffs on top of that. And that does have an impact. And so I do think some profound changes are underway that people are only starting to recognize.
Well, actually, you bring up an interesting topic as far as how international funds flow into the treasury markets and how we've seen rising rates as there's been less buying. Obviously, we've seen the dollar pull back. How are you looking at this trend as far as a longer term picture? Some people believe the bond bubble burst in 2020 when we saw those really low rates, when we were at zero interest rates in some countries and near zero in the US. Was that the top of a longer term bond cycle where we're going to continue to see money sucked out of treasuries?
Well, I'm trying to differentiate between math and politics. So what I just explained was math. The current account has to balance somehow. So if you move something in one way, something else has to happen the other way. By the way, another way to fix the trade imbalance is if you address the disease rather than the symptom. The symptom is the trade deficit, but the disease are the fiscal deficits. If you address those and if you actually encourage investment through deregulation and other things, you can get a long way towards rebalancing trade. So I'm absolutely not against rebalancing trade, just to make that clear. I'm just pointing out that by throwing a wrench into the system with tariffs, that's the sort of side effect you get. What you're referring to, I'd put my macro explanation of that is the weaponization of the dollar. When the threat of sanctions became real to actors not friendly to the US, you're providing a quote unquote disincentive to foreigners to hold their reserves in US dollar. And it's not in their interest to dump all their dollars, but on the margin, they'll make different allocations on their reserves. Gold is a beneficiary on the margin. It's not like foreign central banks suddenly pile all their reserves into gold, but there are some important things that were set in motion. And of course, similarly with the tariffs, no country wants to be as exposed again as they were on Liberation Day. And so they will take actions, and all else equal, yes, it will have an impact. Now, this all has to be seen in the context. You point out that the bond market had been very strong, in part because of Fed buying, but also US equity markets, right? They've been outperforming for years. And one thing we didn't touch on, the Europeans, I mean, they seem to have the Germany alone will spend about €1 trillion on infrastructure and defense. On the EU level, they want to spend a gazillion. And so that is pushing money towards other areas as well. And if we do get the fiscal house in order in the US, that is a headwind to expansion, right? And of course as we're talking, the tax reform bills are under consideration, and it seems like they're not going to be all that contractionary, but it is a huge contrast versus spending over $1 trillion in Europe, for example.
So actually, again, back into the bonds, as you said, usually people borrow money in the US and look elsewhere for higher yields. Right now, the bond market, you can get some pretty high yields in the US. And we did hear of a lot of people shifting some of their funds to money market, more safe plays. But then it also goes to show people are still willing to get bullish on these markets during this rebound. What is your thought about that global situation where the U.S. does seem to be paying higher rates for safe investments?
Well, let me answer the question that I think you wanted to ask. That's my privilege. The one thing, you use the word shift. And the one thing I like to point out is, and Moody's just downgraded the US, and they said, oh, but don't worry, because there is no alternative to the US dollar. Well, that is correct. There is no alternative to the US dollar, but there does not need to be a shift. There can be fragmentation. What we are seeing is that global trade is just going to be more fragmented, that financing is going to be somewhat more local, but there's also going to be much less of it. And so when you throw a wrench into a system, of course, businesses will always find a way to try to serve the customers, but there will be a disruption, and that disruption will be fragmentation. And it's not like some other region in the world is suddenly going to take on this exorbitant privilege that the US has enjoyed for many, many decades. And so I just want to throw that out there, that the alternative to A is not necessarily B, but it might be nothing. And so none of the above type of thing, but in the sense that the flow of money and capitalism is just going to get less efficient. And another symptom of that is, of course, the increased industrial engagement of governments. Depending on how you're situated politically, you may love it, but when you interfere in capital allocation, be that on the monetary side, where it's completely inappropriate, or on the fiscal side, where it's obviously an appropriate political decision, if that's what you got elected for, it does impact efficient capital allocation. And overall, we have a world that's disintegrating. The US is no longer keeping global seas safe so that everybody can trade, is more introvert. Old rivalries are coming back out. To me, when I look at what's happening in Ukraine or Gaza, are just symptoms of a new era, rather than these are specific crises that happen to come and will be resolved at some point. And so through that prism, of course, there are always opportunities out there, and there will be very significant opportunities out there. But I just like to caution to think about a framework where the money is just flowing around and it's a little less attractive here now, it's going to go somewhere else tomorrow.
Well, Axel, couldn't the currency of last resort, gold, be that alternative where central banks around the world have been making it its number 2 asset on their balance sheets behind the dollar? Couldn't some dollars be trickling into the gold market as the uncurrency in a way?
Well, I agree to the second half of that statement. Some money will trickle into gold, right? Let's not forget that the gold markets are comparatively small. It's one of the reasons you have such great volatility in these markets. Governments throughout the world have moved further and further away from the gold standard over the last 100 years. And yes, clearly some countries are increasing their reserves, and that may well continue. But you can only embrace a full gold standard if you have your fiscal house in order. And most governments want to retain the right, and that's phrased about as positively as I can think of, to be in charge of their own fiscal policy. Differently said is that providing gifts to your constituents through entitlements and fiscal spending is something governments are not going to give up easily or at all. And the US probably has a better ability to kick the can down the road. What I've told people is think that, the governments are going to go back to gold standard. I said, well, create your own gold standard, but a government in debt doesn't have interests aligned with you. And even in the US, right, people get excited about the efficiency efforts of Doge. Well, that's just nibbling at the surface. We need entitlement reform. And when I look at the proposed tax changes, there is no entitlement reform. I mean, sure, there's a few things on getting certain benefits that they're tightening that up, but there is no political appetite for serious entitlement reform. And why should there be? Because it will cost votes if you take away entitlements.
Yeah, that is true. And that's what we keep hearing, is just how much the government needs to take care of some of these aspects of the budget deficit, and they're just not willing, or I guess able to do it, one or the other. In terms of this move in gold, very strong gold price. Gold has been going up now for quite a few years, but it has exploded since March of last year, just continuing to break to new all-time highs. It has pulled back after hitting about 3,500, but Axel, in your eyes, since we're talking so much about how governments are shifting their monetary policy, where have you seen the interest come into gold? What's driven this gold move?
Well, just for context, right, we manage over $2 billion in gold and gold mining. On the gold side, we have seen substantial interest, and I might add maybe more with us than some competitors that have had some outflows. So I can't speak for everyone, and we have some slight differentiations. I don't want to get into them right now too much, but we certainly have a lot of interest. One of the things I say is that some views that have been considered fringe views in the gold bug community are moving more mainstream. And that trend is well underway. On the gold mining side, the gold miners have been out of love, out of favor for a long time. They've obviously done very well. The challenge for the large miners has been that they are so large. They produce 5-7 million ounces a year. They can't replenish that fast enough. So they've gotten involved in these huge copper gold projects that are difficult to execute on time and on budget. And so much more of the activity has been happening on the junior space. That said, on the junior space, many of them are not in the ETFs, and so they're not accessible to many investors. And the junior space is very volatile. Well, on the very volatile spectrum, there's quote unquote competition in the digital asset space that folks that really want volatility, a lot of the folks are attracted to that. And so even though that space has done quite well, given how much the price of gold has gone up, and with that, how much the expected margins are expanding, actually, I don't think we have seen much. And just to talk about the margins briefly, historically, the last few cycles we've had, when the price of gold has been going up, commodity prices have also gone up, which dampens the margins. About 20% of production costs is just energy. And we haven't seen that this time around. Or similar labor cost. Given that other commodity prices are not through the roof, labor cost hasn't exploded as much as during other bull markets. And so the conditions are actually very, very favorable. And many of these mining companies have done their budgets with gold rather substantially lower than it is right now. And so it's just investors have gotten burned so many times. On the positive side, it means that I'm not concerned about the valuations. I'm quite the contrary.
Well, Axel, I'm glad you went into the gold margins and how they've been increasing. We're actually at the highest margins the industry has ever seen. And when you look at the trends the last few quarters, from Q3 to Q4 to Q1, and arguably Q2 is going to be even higher, is it getting to the point for generalists that maybe haven't looked at the space or maybe were burned in the past, where when you see the earnings potential of even the intermediate gold producers, not just the majors, but even some of the mid caps, they're becoming so large that it's going to be hard to ignore. Do you think that brings some generalists to the space that maybe have stayed away in the past?
Well, on the margin, yes, but it's not easy because the active management had been dying for many years. It's volatility, bear markets that bring active management back. In the gold space, in our analysis, it has the greatest dispersion of returns. Now, that may sound like a mouthful, but it means that the returns are all over the place in different gold miners, which means active management really matters. And so there is just not enough expertise out there to do the sort of analysis that's required, which also means that, of course, you can find some very good value. I mean, so it's a less efficient market. But money tends to first flow into the ETFs, and then to the other spaces. If you look at the major gold ETFs, they've actually had steady outflows over the last several years, and that hasn't reversed. I just looked at it again. And so there is more interest and appetite, including on what we do, but investors have just gotten burned so many times that yes, at some point, you would think that the interest is going to pick up significantly. But we haven't seen that. And maybe to make a broader point, when this huge volatility we saw in earlier this month was mostly institutional driven. Retail investors were actually the calm ones. And so it's leveraged institutions, hedge funds that delevered. You see that also if you just go to the gold space. The premiums in coins hasn't exploded. So there is no panic buying of coins or anything like that. All of that leads me to believe that we are far from the end in the bull market in this space, because that's not how a bull market ends in gold, at least historically speaking.
So, Axel, how do you make sense of, the GDX, GDXJ, those seeing outflows? Not huge outflows, but still some outflows compared to the almost historic inflows that gold-backed ETFs like GLD and other ones have experienced over that exact same time period?
Well, they serve little different markets, right? I mean, we like to talk about gold and gold mining in the same sentence, but the risk profile is really different. Price of gold is about as volatile as equities, with some surges in between. Gold miners, even the major ones, tend to be a tad more volatile. In the junior space, there are literally options on finding gold. and so they can be substantially more volatile, and so they're used for different purposes by different investors. We know investors who only buy one or the other, and and so it's not like you substitute one for the other. And of course, on a risk-adjusted basis, in recent years, the price of gold has outperformed gold miners. And so people are saying, well, why do I take on that extra risk? And then similarly, on the active management side, they said, oh, yeah, I get gold exposure to the miners. I don't want to take on additional risk, not realizing that buying the quote-unquote index is actually in itself a significant risk, because the quote-unquote index is passive and whatnot. And so what we try to do is we try to not just buy miners based on the price of gold, but on company-specific catalysts. And they can be more company-specific, but they can simply be, as these companies grow, they attract bigger investors, they get added to indices, and so and historically anyway, the valuations tend to be higher as these companies get added to indices and things like that. And so that helps to add additional value. It's a fascinating space, but it is one where deep insights are helpful, and it's just a very small number of people that take the time to actually try to get that sort of insight.
Well, Axel, we could talk about an even smaller market, which is silver, and it's also one that people are interested in that invest in the precious metals equities. The silver catch-up trade has been one people have been talking about for a while. A lot of people point to the high gold-silver ratio, showing just how many more ounces of silver it takes to buy 1 ounce of gold. Do you expect there to be a catch-up trade where silver comes from behind and finally does blast higher?
Well, the reason I like to talk about gold, because I'm somewhat of a simpleton. All these macro things we talk about, they're all directly applicable to gold because it is so sensitive to interest rates, to real rates. Whereas when you go to silver already, because of the heavy industrial use, the dynamics are far more complex. And then when you go to the miners, one of the challenges in silver is that silver is often a byproduct. And there are not many good silver producers. And some of them are not even accessible to the public, easily anyway. There's one we have in one of our portfolios that's actually a private holdings, and I don't want to talk about it here for regulatory purposes, but they're not easily accessible. And so it's one reason why on the equity side, it's not the most beloved side of things. But yes, on the other end of the spectrum, price of silver is of course very volatile, and that has attractions to certain types of investors.
So Axel, as much as we talk about, again, those outflows and the type of investors that are looking at the gold stocks, one thing I have noticed, especially in the last couple of weeks, is all the financings taking place. We were seeing a lot of financings focused on bigger companies, bigger dollar amounts being raised in the 20, 30, $50 million trend, that being over the last year or so. But recently, I'm noticing a lot of smaller deals getting done, sub $10 million into smaller companies. You have any insights on this, where the funding's coming from and why we're seeing more fundings being done in the smaller companies?
Well, I mean, because there's a bull market, right? I mean, that's the short answer. I turned more positive on gold miners, and when Jay Powell, the head of the Federal Reserve, left out the words of what did he say about it? The tight environment that he wanted to have, restrictive financial conditions. When you ease financial conditions, these small mining companies, they're not. They often do equity financing, but they are in many ways credit plays. When financing conditions are tight, it's more difficult to access financing. And of course, with a higher price of gold, the opportunity is perceived to be much better, and so it's starting to get easier to get access to financing. So it's just that gaining momentum. I happen to think we're still though in the early innings of that. I haven't seen many big unreasonable, overpriced sort of takeovers or mergers. And so when people are starting to scramble and panic to get into the trade, that's when I'm concerned. But yes, the overall environment is friendlier, and that means financing is more accessible. And it's just a sign that this market is a more positive market than it had been.
Oh boy, is it ever. And it does just keep on playing through that playbook, but you're right. We are still, it seems like, waiting for a lot more M&A to happen, to go further down the food chain, and maybe some bidding wars to happen as well. But hey, that'll give us many other things to keep watching for in this precious market, or precious metals bull market right now. Axel, we're out of time for the weekend show, but again, this has been Axel Merk, President and Chief Investment Officer at Merk Investments. Axel, it's always great having you on the show, and everyone, thanks for tuning into this weekend show. Please remember, go back through our website, podcast, YouTube channel, subscribe, like, comment, and share our interviews with all of your friends. We love hearing from each and every one of you, so please keep in touch with Shad and I through email. Everyone, thanks for tuning in this weekend. Axel, thanks as always for your time.
Thank you.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.